Hey everybody, and welcome back to the 5 Pillars of Wealth Mastery. I want to congratulate you. You've made it to the 5th pillar. All right, it takes a lot to go through these courses. Not everybody that starts something actually follows through. You know how many people start courses or start reading books but never finish them? So just take a moment and just, honor yourself for really going through this and taking the time to learn some new strategies and tactics that can really improve your financial life, improve your life in general, just by being in a position to achieve your financial goals. So in the past few videos, we've talked about really important pillars, and it's been a progression. And I want to tell you today we're going to talk about our mindset, the mindset of mastering your wealth, which I would say is my favorite pillar, and I would say is the most important of all of them. And not to discount the first pillar of building your wealth and making sure you preserve it. I talked about the Mount Everest effect, that you're trying to reach the summit and then ensure that you don't run out of assets, and all the trials and tribulations and things you need to put into place, and understanding your cash flow, the right amount of savings, kind of like the gas that goes in the tank or the jet fuel to make sure you can take off in New York and land in LA, right? So all very, very important. Then we talked about, wealth protection. And this was that you've done everything in building and preserving it. How do you make sure nobody takes it from you? And so we went through that, also very important. Then we got into how do you boost your net worth and really move the needle to achieve your goals even faster by how do you pay off your mortgage quicker? Right? How do you get out and restructure your debt, or even boost your returns by mitigating, in some cases, eliminating taxes? Also, very important pillar. Then we talked about your legacy in the legacy pillar, which is what you want to happen to your money after you pass on, after we inevitably pass on, or if we're, God forbid, incapacitated and not able to run things, how are those decisions going to be made? Now, all of those pillars, all extremely important. Our mindset, the most important. All right, I'm going to just pull this up real quick so you can see everything starts with our goals. And the 5th and final pillar, which is the mindset of the wealth master, I say is the most important, and I'm going to tell you why. And I'm just leaving this up on the screen now. So about 10 years or so ago, there was the financial crisis. It was one of, if not the worst financial disasters in the U.S. economy and the stock market, really since the Great Depression. And really the idea of people's psychology around what was going on in the world, and how many people made choices that either made or break them, was indicative of their mindset. Now, a very close friend of mine, his father at the time was just approaching retirement. And he had nailed all of these pillars, right? He had worked his entire life. He reached the summit. He got to a point where he had the right amount of assets. He had the right plan in place. He had the right protection, the right insurance, all of those things. They didn't really have much debt. They restructured their mortgages, and, they were close to the finish line there. And they had their estate plan set up. But the mindset is really what makes or breaks it. They did everything right. All of the things were right. And at the 11th hour, when the worst happened, my friend's father capitulated and panicked. And we saw, look, this is an emotional thing for many, many people, is that we tend to not make decisions around our money because of ration and logic. We make them because how we feel. And he made rational, logical decisions and made every pillar, each one of these pillars, he nailed up until the 5th, which was his mindset. When the market started to implode, and every time he opened the news or turned on the TV, it talked about, the end of the economic engine of the world. And his instincts were to like, you know what? I got to sell everything and just go to cash and wait for this thing to blow over. And he wound up making that choice. It just was eroding and getting at him. And it got to a point in early 2009, I think January or February, in the first couple of months. I mean, it was really bad. It was at the darkest part of the bear market then. And, you know, his assets were down more than 50% at the time. I don't know exactly what it was. I mean, this is not somebody that I advise. It's just a friend's father who was like, you know, venting to me at like a backyard barbecue. My heart really went out to him. And, you know, it turned out I lost like, you know, let's say around half his assets that he realized at the time, and his best earnings years were behind him. Now, to add insult to injury, the following month in March of 2009, for no reason whatsoever, the markets turned around and went on one of the longest, strongest bull markets really that we've ever seen. One of them anyway. And it's really interesting, had he not let his emotions take a hold of him, within a pretty short period of time, he would have been okay. And, you know, the aftermath of that, of not only seeing it all evaporate, but making the choice because of his own mindset, which was wrong, just making the decisions of how he felt it was over and not having a sound basis of how to make a decision, wound up having to go into therapy. I don't know if he had a nervous breakdown, but he was not in good shape for a long time because he capitulated at one of the worst possible times, and then things turned around and the world got better, and he was sitting, you know, it was over. And, you know, his working years were behind him. So I want to impart to you that you can do everything right. You can have all the ration and logic behind every single pillar. But if we don't control our mindset and how we react to things in the marketplace and react to our own emotions, good times and bad times, and I'm going to show you how that plays out, that can make or break you. All right, so this is why it's the most important thing. You could do everything right, but if we don't master this, our own psychology, it could be the end of us. All right, so I want to get into it today. I'm going to pull this up real quick. Let me blow this up for you. Okay, so I like to say that the biggest single threat to achieving your goals or achieving your dreams is your mindset. You know, and also, like, I'm not the only one that says this. Benjamin Graham, who, if you don't know who Benjamin Graham is, he is the father of value investing. He wrote this incredible book called The Intelligent Investor. It's a little dense, but if you have the time and you want to read it, I think it's a must read for anybody that's interested in investing. He was the teacher of Warren Buffett. So if you don't know who Benjamin Graham is, I'm sure you've heard of Warren Buffett. Warren Buffett's teacher and mentor was Benjamin Graham. And he says that the investor's chief problem, and even his worst enemy, is himself. Like my friend's father. Like, at the end of the day, it was his choice. He was his own worst enemy. He had done everything right. All he had to do was control his emotions, the way he felt, and he would have been in a much, much better light. So today we're going to go through some of these emotional biases that we all carry, that we're hardwired into. And I'm just going to pull this up real quick. So it's a term that we like to call behavioral finance. And let me just blow this up so you can see this here. And behavioral finance is these cognitive biases and these emotions that cause rational, illogical, and smart people to act or behave, well, you know, irrationally. Now, when I really like talking about this and learning about this and studying this, because I remember when I first started in the financial world, I was in my early 20s, and it was at the height of the internet bubble in like the late 90s and early 2000s. And we all know in hindsight that these companies where people were buying were trading at ridiculous multiples. They weren't making any money. And it was all just like this hype around, you know, just it's going to the next level. And I remember being at a family dinner. I had some family that they were very, very successful people. These were CEOs. These are entrepreneurs. These were people that really were dialed in. And I remember being at dinner. I was like 21 or 22 years old. I was studying all this stuff at the time because I was just getting into the industry. And all these really smart people were talking about these internet stocks that they were buying for these ridiculous prices And I knew because I was like studying these things at the time. Now I wasn't like an event, I was a student getting into it, but it didn't make any sense. They were just buying based on like the hype, and they were juicing each other up, and they were buying more and more. And the companies that they were buying, they were, all the tech stocks at the time, not all of them, but most of them had no earnings at the time. And when the bubble burst, things that were trading at huge valuations came crashing down. And we all can kind of speculate as to what happened to their holdings. And fast forward a number of years later, we saw the same type of psychosis, if you will, in 2006, 2007, before the financial crisis. Same folks getting involved with people like Bernie Madoff, and just kind of following the friends of friends that, thought that this was the next best thing, and just kind of looking, and it dawned on me, how are these uber smart people, right, making irrational decisions that make no logical sense whatsoever? These were very successful people running successful companies. These were people that you would look at and be like, well, they're successful. How are they acting so irrationally time and time again? And so this is when I say that out of the 5 pillars, the mindset is the most important pillar, that even the smartest and most successful can fall victim to this. And I want you to think about behavioral finances. We are all of us, still hardwired like we're the cavemen from, thousands and thousands of years ago. So I want you to think about it like this. We have caveman brains, right? We are hardwired like cavemen. And if you were a caveman 10,000 years ago and you had to go get dinner, you went out on the hunt. And so let's say you're out on the hunt, and then out of the forest, a grizzly bear jumps out to attack. Well, the first thing that the caveman's mentality is to avoid pain and seek pleasure. So the grizzly bear, that's painful. So the first thing that they would do is they would go back to their cave, and they would hide and wait for the grizzly bear to go back to hibernation so they can go out and look for food. So fast forward to today, we can go to Whole Foods to get our dinner. Or we can Uber Eats. It's really easy. We don't have to go out and get confronted by a grizzly bear. But when it comes to our investments, we are confronted by a grizzly bear market from time to time. And that same caveman mentality is to avoid the pain of the grizzly bear market, kind of like my friend's father did, and kind of go run and hide, put everything in cash or whatever just to feel secure, put it under our mattress, and wait for the things to blow over, the bear market to go back into hibernation, then come back in. Now, you've probably all heard the saying, buy low and sell high. Well, that's common sense, right? Buy low and sell high. But if we go back into the cave at the bear market, that's selling low. And if we come back when the bear market goes back to bed, right, then we'd be buying at an elevated price that would be buying high. So that doesn't make sense. We're supposed to buy low, sell high. So if we give into our caveman mentality, we're selling low and then maybe coming back and buying high later. Common sense, not always common practice. So today we're going to go through some of the biases that we're all wired into, so you become aware of them. And then I'm going to show you some techniques and some solutions that can help you overcome them. So let me just go back to this here. So, and the reason why I bring this up is we all have these blind spots that make it really challenging for us to make rational, logical decisions, financial decisions, if you will. And the reality is I really want you to take this in. We all are making decisions emotionally, how we feel, not rationally and logically. So basically, the idea is, how do we reverse that? And there are some strategies and tactics that help you understand the biases of how we're all making emotional decisions, and how we can pause, take a breath, and think rationally and say, does that make sense? You with me? Okay, let's get into it. Let me just pull this back up. The first bias, let me blow this up, is what we call confirmation bias. Now, confirmation bias is really just a tendency to interpret new evidence as confirmation of our existing beliefs or our existing theories. Now, the confirmation bias is really everywhere. It's not just in finance. So I'll give you an example. Have you ever followed anything to do in politics? All right. In this day and age with the 24/7 news cycle, everybody has an opinion on something. So let's just use something that's been around a long time. Let's say that the topic of capital punishment is something that, let's say you believe, your bias is that you believe capital punishment works. Okay, just work with me here. And a report comes out that says capital punishment doesn't work. A statistical finding, a study came out and said, it doesn't really work. Because we have these preset biases, that we're going to look at everything in that study of why the study is wrong. Well, the way they collected the data is wrong. The author is not really qualified. We're going to pick that report apart, and we're going to look for people that say, yeah, that report was not done well. So we're going to look for people to confirm that even though the study says that it doesn't work, right? And I don't know if there's a study out there. I'm just giving an example here. We're going to look for people to confirm that, yeah, that study is no good. Now, if we flipped it around and let's say the study came out and said, yes, capital punishment works, capital punishment is good. Okay, great. That confirms our beliefs and nothing more to see here. Validity of the report in check. Right? Same thing the other. If you're against capital punishment and the report came out that says it doesn't work, all right, confirms your beliefs. If it does work, you're going to say the study's no good. So think about that. If you don't follow politics, and let's say you follow sports, right? So I'm a huge Yankee fan. I grew up in New York. I don't live in New York anymore. I live in Connecticut, but I've always been a diehard Yankee fan, and I'm raising my kids to be diehard Yankee fans as well. And so back in the 90s, when the Yankees started to go on their winning streak in the very early stages in 1996, which was the year they won the World Series, in the playoffs, right? Derek Jeter, who at the time, if you don't know who Derek Jeter is, he's like an icon in baseball. He was a rookie at the time, and in a playoff game against the Orioles, he hits a questionable home run. Now, the reason it was questionable, it goes to right center field, and one of the fans, who was a young kid named Jeffrey Mayer or something, he reached over the wall with his hat or his glove and caught it in play. And back then, they didn't have replay like we have today, and so the umps ruled it a home run. I'm a Yankee fan. Nothing more to see here. That's a home run, and it's propelling the Yankees to the next round. Okay? Now, if I was an Oriole fan, we'd be looking, the ump is wrong, this should be reviewed, we should have replay in baseball, and it would be a whole thing. So we take our confirmation biases very seriously in every walk of life, when it comes to politics, when it comes to the teams we cheer for, and when it comes to our investments. So I want you to pause now. Do you think about your investments or your investment strategies or any financial strategy, and you're going to think, you want to confirm that what you're doing is right. You don't want to be wrong. And so you're going to go onto the message boards. You're going to read reports that say, yes, this is the right thing to do. And you say, okay, great. Instead of looking at it objectively. Because the biggest issue around confirmation bias is we're only seeking out any type of thoughts or ideas that confirm what we already believe, not looking for the truth. Now, we may find out if we look at everything objectively that, yes, what we have in place is in fact right and all good. But unless we look at differing opinions on things, how do you know what you have is right? Same thing going back to the baseball game. If we had replay at the time, they had replay, but it wasn't something that the umpires would look at. But it was clear as day that would, in today's world, would not be called a home run. And I can say that as a Yankee fan, but I was quick to dismiss it then because I wanted the Yankees to win. So it's very important that you're aware of this. Now, how can you be aware of this? Well, I'm going to show you a really quick solution and some questions to ask when it comes really to anything. But today we're talking about your finances, to make sure you're getting all of the available information so you can make a well-informed, educated decision. And sometimes it confirms what you're doing, and that's okay. And sometimes it says, well, actually, we should look at things differently, and that's okay, because that's how you make a smart decision. So let me just move this over here. All right, let me blow this up. So the first thing that you want to do, the real solution around confirmation bias, is you want to find qualified people that disagree with you And you want to find out why. Like, why do they disagree with you? Now, this is really important. Don't ask like your Uber driver. I'm not saying the Uber driver is, but probably not qualified to talk about an investment strategy or any type of high-end financial strategy. So you want to find qualified people that have a different viewpoint, that disagree with your stance, and then provide reasoning. Now, the things you want to ask this person, let me just blow this up again. You say, well, what don't I know? Right? Where about my logic? Give them your reasoning and say, well, where's my logic wrong? You know, what should I really be anticipating that I'm not? What are some of the real risks that I'm exposed to that I'm not really considering now? And then if you're not comfortable with their answers, or if you think you need more information, ask them, well, who else should I be speaking with? Who are the other people that are, you know, industry leaders, that are experts, that can shed some new light on this before I make a decision? So that's really how you deal with confirmation bias. You with me so far? Okay. So actually, I'm going to just blow this up again. Maybe you want to write this down or take a screenshot of this, just so you know how to look at things when you have these preset biases, just so you know how to ask the right questions and who to speak to when it comes to making a decision. Okay, let's move on. So the next is what I call recency bias. Now, recency bias is that we tend to pay more attention to recent events and we ignore the past or what we believe the future is really going to resemble. Now, recency bias, going back to the story that I told early in this video about my friend's father, that's recency bias. He thought that recently the markets crashed and that would continue for the near future. And his decisions were made because he felt it was game over and he didn't see any light. He didn't see anything that would give him any reason of why what recently happened, which was a terrible bear market, would ever end. And clearly we know the aftermath of that. Now, this also works on the other side. This is not just when things happen badly. So I want to give you an example of recency bias. Back in 2006, Fortune magazine did an amazing profile on this all-star fund manager, as a mutual fund manager. His name was Bill Miller. And the reason Fortune came out with this profile for him is for the prior 15 years, Miller's fund, with him at the helm, outperformed the S&P 500 every year. Okay? That's like a Herculean task. Herculean, I can't even pronounce that. That's a really big task to outperform the S&P year in, year out. And so he got all this fanfare, and people said, well, if he kept doing this over the past 15 years, he's got the magic touch. He knows something that the rest of the world doesn't, and, you know, I want that edge. And we started seeing, you know, hordes of money go into the fund. And what happened is, 2006, the year that Fortune came out with the article, wasn't such a good year. It was actually his first year he underperformed the S&P 500. 2007, second year underperformed. And in 2008, he did so much worse, and it was more than a 50% loss in the fund, that it erased all the outperformance of the past 5 and 10 years. So it's really sad because we see this. This is like all the investors that read this article, that he's got the magic touch. He did it. He's going to keep doing it. You know, really got the short end of the stick. So I want you to be very aware. Recent events, good or bad, really don't have bearing of what's going to happen in the future. We always talk about, you know, the past performance or the past, you know, economic activity doesn't mean what's going to happen in the future. New things will happen, good, bad, or indifferent. So I want you to take this into account. Really be very careful about making decisions about what recently happened. If that's your decision basis about, all right, this just happened, so it's going to continue. Like the tech stocks in the 90s, like they went up 1,000% or whatever the number was. It's going to continue. It doesn't mean it's going to continue, and most of the time it doesn't. So recency bias is a really powerful bias that, you know, it's just hardwired in our brains. So I want you to be aware of these things and pause when you think, I'm going to make a decision because this just happened and I feel like it's going to continue. So how do we deal with it? Let me just pull this back up. Okay, this is a great quote by Warren Buffett, and you may have seen this before. His quote is, Be fearful when others are greedy, and greedy when others are fearful. Now, I want you to think about this for a second. Be fearful when others are greedy. So back to like the tech stocks of the 90s, you had people from every walk of life thinking that stocks that went through the roof were going to keep going, which is why they kept buying more. And so the world was really greedy at the time, and that's when we should be the most fearful. So recently, like in the 90s, tech stocks had boomed, and so that was their recent performance, but that's really where we need to pause and be like, maybe I should question this. Maybe it's time to be a little fearful of what's going on and look at things more objectively. Now, the second part about this is being greedy when others are fearful. So just like my friend's father, who was fearful, panicked at like the worst, darkest time of the market, that if we were greedy at the time, if we thought like, wow, this is actually a great buying opportunity, hindsight being 2020, could have been one of the really great, if not one of the best investment opportunities or buying opportunities in the markets because they were such cheap prices. But everybody was fearful at the time. So the recency bias is that we think things are going to continue based on what they recently done. Think of Warren Buffett's quote, be fearful when others are greedy, right? So recently things have been really good or whatever it was. That's when it's time to pause, recheck, or be greedy when others are fearful, when the panic sets in, when the corrections happen, when the bear markets happen. It doesn't mean it's going to last forever. It's time to pause, and maybe it's an opportunity. Are you with me so far? All right, I know we're rolling here, and we've gone through two really important biases. We're going to keep going. We're going to keep moving on. You know, you can do this. You can get control over your mindset, and once you do, you can really be in a position to make powerful decisions. So I'm really excited that we've gone this far, and we're going to go a little bit deeper now. So let me just pull this back up. Okay, overconfidence bias. Overconfidence bias, probably one of the most important biases we all tend to share. We tend to overestimate our knowledge, we underestimate the risks, and we exaggerate our ability to control events. So overconfidence bias has been one of the biggest issues around major disasters. It's been said that overconfidence bias was the reason for the Titanic disaster. Think about this. They came out with the Titanic and they said, ship can't sink. Talk about overconfidence. Man-made ship, not going to sink. All right, hits an iceberg. We all know what happens. Overconfidence bias was said to be the cause, one of the causes around the Space Shuttle Challenger or the Space Shuttle Columbia disasters that happened years ago. We see this in investment all the time where people get involved and they have a couple of winners and they think like, I got the magic touch, and basically trade their life savings away. So we see it time and time again. So I want you to think about this. There was a study done by Psychology Today. And in this study, they talked about 93% of people they surveyed that talked about their driving ability, right? How well they drive. 93% said they were above average drivers. Well, if now over 90% of people are above average, what's the average? So the point is that we all tend to have this thing that we're better at something than we might really be. Okay, I would say that the F1 drivers or the NASCAR drivers are probably above average drivers. But the day-to-day people that are going to and from work or commuting or dropping the kids off at school, probably in the average space. But our overconfidence in our ability to be an amazing driver. I remember watching a Seinfeld years ago, and George was talking about his parking ability, and he wound up taking over parking for the street, and it was a disaster. So the point is that we tend to overfeel like we're better than what we might really be. And when it comes to our investments, it can have disastrous effects. If we start thinking we have this magic touch, you know, the reality is you can wind up being in trouble. Now, and we're all victim to this. I mean, have you ever sat down and thought, I just feel the market's going to crash, or I feel this stock is going to take off? You ever? I've said it, and because again, we make decisions based on how we feel. So if you've ever said this to yourself, the worst thing that can really happen is that actually happens. So like, if let's say you were looking at a company and you're like, this stock's going to take off, and it does, then you start to think you have an edge, that you know something, you have this instinct that others don't. And with no real evidence to back it up other than it was a feeling. And it was a total coincidence, because you might have had that feeling and I might have had the complete opposite feeling. And maybe about a different thing, I had the opposite feeling and it worked out in my favor. So there's no, evidence or strategies or any research that was done. It was just a hunch. And then we start making decisions based on that we have this edge. And I want to say, look, if you were really that good, or you really knew what was going to happen, you should be running a multi-billion-dollar hedge fund, and we should be talking about this on your yacht. Not everybody is Warren Buffett. Not everybody is Ray Dalio. Now, it doesn't mean you can't make smart, educated, informed decisions. It doesn't mean that you can do things the way that they're doing them. But the reality is to get very honest with yourself. And so let me just pull up the solution to this, to our overconfidence, is you want to get honest with yourself and ask yourself, do you really know? Have you done the research? And even if you've done the research, doesn't mean it's right. But is it just something that we feel? Because again, we make decisions based on how we feel, not on ration and logic. Or have we done the due diligence to say, well, you know what, I really have good input here and I'm making a really good educated decision. May or may not be right, but the reality is that we've done our homework. And then what I would say is that, all right, if you've done your homework, right, all right, you've got to the point where you felt a certain way, but you've done the research and you feel good about it, it's time to then seek counsel or guidance from qualified, experienced professionals. Kind of like what we talked about earlier. Get somebody that can find a hole or a gap in your reasoning and somebody that may disagree with you. What are the risks that you're exposed to? And again, we talk about qualified people that have experience. This isn't somebody that you're talking with, at the club, unless they're, an experienced professional that really knows what they're doing. And you vet this out over time and you figure out, other than the hunch that we have, is it a real opportunity? Is it something that you should explore further? Okay, let's move on. So the next is what we call loss aversion. Let me pull this up. Now, loss aversion is a really important bias that we see all the time in the financial markets, and we see it really everywhere. Now, loss aversion is really just a matter of that financial losses cause us to have twice as much pain than the pleasure that we get from a financial gain. So I want you to think about this. The idea of losing money is more painful than the idea of making money. So in a great book that, if you have some time to read it, Dan Kahneman wrote Think Fast and Think Slow. He did this amazing study on loss aversion. And what they did is they studied these professional golfers. Now, I play golf, so I really enjoyed reading about this study. And what they did is they analyzed over 2.5 million putts of when these professional golfers were putting for par, which when you're putting for par, if you miss it, you get a bogey and you lose a stroke. So they wanted to see what the concentration looked like and how successful they were to avoid losing the stroke, or versus when they were putting for birdie, which means they would actually gain a stroke. And they analyzed over 2.5 million putts over all these professional golfers from every possible distance, long distance, short distance, different holes. And what they found is that the golfers tend to be vastly more successful when saving par, not losing a stroke, than for when they putted for birdie. So the idea is that people tend to be more concentrated against losing something than actually gaining. So when it comes to our investments, this is why it's not really such a good idea to look at investments or your finances on a day-to-day basis, because there's ebbs and flows in the markets. I mean, the markets do this every day. Sometimes there's booms, sometimes there's busts, there's corrections, but day-to-day things are moving around. And if we're looking and we see a little loss, that has more of an impact on our subconscious, our psychology, than a little gain. And we tend to get into a position, if we see too much of that, is start questioning our strategy and saying, well, is it right? And not recognizing that it's probably just due to the ebbs and flows of the markets. So the idea around loss aversion, to be aware of that we, as just our instincts, we're more fearful of losing than gaining. So what do we do? How do we handle it? So let me pull this up here. All right, let me blow this up here. The first thing I would recommend doing is go on a financial diet for 30 days. Now, financial diet, this means no financial news. No CNBC, no Bloomberg, no Wall Street Journal. Just tune it out. All right, because whatever the Dow is doing that day really has no bearing on the long-term effects. Think about my friend's father dialing into the news and seeing like, oh, you know, the Dow is down again and all the pundits coming out saying the world's ending. It got into his psyche and made a bad decision. Now, if let's say he was on a 10-year news diet and he didn't even go, he just went about his business, he'd probably be in a good shape right now. He wouldn't have made those bad decisions. And let me just blow this back up. When it talks about reviewing, now we've gone on the news diet, reviewing your actual financial portfolios, I'd say at least for 30 days, no portfolio review. And going forward, you want to think about doing a review of your finances at the most quarterly. All right, and really not that much is going to change quarterly, but if you have to look, I would say every 3 months or so is probably the most you ever want to really look at these types of things. And then I have another great quote from Warren Buffett, which is what I really, really love about Warren Buffett's psychology. It seems like he's really nailed the psychology around investing, which is why he's been so successful. And this is one of my favorite quotes. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. You put together a portfolio of companies whose aggregate earnings march upward over the years, and so also will the portfolio's market value. Now, the reason why I love this is, I'm not saying to be a stock picker, but you have this portfolio that's getting you to the summit. And the idea is that if you have a 10-year mindset, like my friend's father, if he had a 10-year mindset as opposed to what was happening at that point in time, realizing there's going to be some storms. Remember in Pillar 1, I talk about the Mount Everest effect? To get to the summit, it's not just a stroll. There's going to be some storms. There might be an avalanche. There's going to be trials and tribulations along the way. But the idea is to keep looking at that summit and keep marching forward. And the same thing holds true when it comes to loss aversion. If your goal was to climb Mount Everest and there was like a storm and you said, I'm not going to climb, I'm going back home. Well, you're never going to reach the summit. You're never going to reach your goal. And because you're scared of that loss of like being cold for a little bit or not being able to weather the storm. So I want you to think about this when it comes to our finances. These cognitive biases that we all share can wreak havoc, which is why I say you can do everything right, but our worst enemy to our finances is ourselves. Because we're making decisions how we feel. What I'd like to impart to you is to still feel, but pause and get insight to control our emotions and start making decisions rationally, logically, and make sure things are aligned with our long-term vision. Okay, now I want to just bring this up. My key takeaway, our behavior, your behavior, my behavior, really how we all react to all the noise, the storms, the booms, the busts. This is what's going to dictate whether or not you reach the summit or you die on the mountain. All right, so that's the key. It's if we control our emotions and we understand our mindset, our pre-wired caveman instincts, and we start making decisions rationally and thoughtfully and not instinctively. Remember that grizzly bear. It's not running back to the cave, right? We can buy our groceries at Whole Foods. The grizzly bear comes every so often. So when the grizzly bear does come, let's not be so quick to run from the pain of it. It could potentially be one of the better opportunities of your life. Be aware of the biases that we all carry and think about some of the tactics to how to overcome them. And I think that we're all, susceptible to at least one of these biases, if not all of them, in some aspect of our life. So I hope that I was able to bring some new perspective on how we can really handle our emotions and our mindset when it comes to our money. I hope this message has served you, and I hope you've really enjoyed these 5 pillars. But guess what? It's not over. All right, I'm going to give you a bonus. I'm going to give you something that really brings this all together. So the 5 pillars, right? We talked about starting with your goals. we talked about, let me pull this up here. We talked about the wealth preservation, protection, boosting your wealth, your legacy, your mindset. Now what we're going to do, I'm going to bring you another video which talks about your expert team. All right, and this is what brings it all together. And the reason why I'm doing this is that so many people have said to me, Mike, like all of these pillars, all these verticals that we have to work in, how do you deal with it? You know, how do you deal with organizing it all? Who are the people that we are supposed to entrust to give us advice and counsel? So I wanted to square that circle for you. So stay tuned. I'm going to have another video coming out to you in the next day or so. You can even just, fast forward to the next one. And you're going to go through, I'm going to walk you through, who are the professionals that you need, how you find them, how to avoid the ones that, are the wrong professionals. And then I'm going to show you a really interesting strategy that you can analyze if in each pillar that you have, if it's going to deliver the way you want, or if there's any problems or any gaps and how you can actually address them. So again, I hope this message has served you. Stay tuned. The next one that brings everything all together and really, looks at all the pillars and makes them work cohesively is coming at you next. So I hope this message has served you. Continue to make smart, rational, logical decisions around your money so you can achieve your financial goals and you can improve your life. I'm Michael Gold. Make it a great day.